This shape on a chart looks exactly like a teacup, and it's one of the most reliable bullish signals in all of trading. Let me show you how to spot it and exactly how to trade it. It starts inside an uptrend. Price has been climbing. Then it takes a breather and pulls back. But watch how it falls, not in a sharp spike, but slowly, gently rounding out at the bottom like a bowl, and then curving back up to about where it started. That smooth, rounded dip, that U shape, is the cup. And the key word is rounded. A gentle curve is what you want. A sharp V is not a real cup. Now, when price climbs back to the top of the cup, it runs into a ceiling, the same level it originally fell from. We call that the rim, and it's your resistance line. Most of the time, price won't smash straight through it. Instead, it drifts sideways or dips just a little in a small, quiet pullback right below that rim. That little dip is the handle, exactly like the handle on the side of a teacup. And here's a tip. The smaller and shallower the handle, the stronger the signal. A good handle only gives back a small part of the cup, not even close to half. So that's how you spot it. A rounded cup, then a small handle on the right sitting just under the rim. Here's the story behind it because it's simple. The rounded cup shows sellers slowly running out of steam while buyers quietly take over. And the handle is the final shakeout. The last nervous sellers get out, right before the buyers push price up and out. Now the part you really came for, how to trade it. 3 steps. Step 1, your entry. You do not buy while the handle is still forming. You wait. Your signal is the breakout. The moment price closes above the rim, above that resistance line. And it's even better if it breaks out on rising volume, because strong volume means real buyers are behind the move. Step 2, your target, how far it could go. This part is beautifully simple. You measure the depth of the cup from the rim down to the bottom. Let's say the rim is at $50 and the bottom of the cup is at $40. That's a depth of $10. Now take that $10 and add it on top of the breakout. 50 plus 10 gives you a target of $60. Step 3, your stop loss, your safety net. You place it just below the low of the handle. The logic is clean. If price breaks out but then falls back under the handle, the pattern has failed. And you get out with a small controlled loss instead of a big one. One more thing to make your eye sharper. Volume. In a textbook cup and handle, volume quietly dries up as the cup forms, goes very calm at the bottom, and then surges on the breakout. A breakout backed by a spike in volume is far more trustworthy than a quiet one. And the honest truth, like with every pattern, this is not a guarantee. It's an edge, the odds tilted in your favor. You wait for the breakout, you set your stop below the handle, and you let the winners run toward target. That is how the professionals trade it. One quick but important note. This is educational content, not financial advice. Patterns only tilt the odds in your favor. They never guarantee anything. So always do your own research and never risk more than you can afford to lose. So there it is, the cup and handle. A rounded cup, a small handle, a breakout above the rim, and a target equal to the depth of the cup. Spot it, wait for the break, and trade it with a plan. I'll see you in the next lesson.